Hello everyone, my name is Jeffrey Kennedy, editor of Trader's Classroom. Recently I was asked to take a look at the price charts of GameStop and weigh in from an Elliott wave perspective. Well, considering the volatility that we've seen in this issue, I actually thought it would be quite fun to do so. So that's what we're going to be doing in this short video. So I'm going to show you, I guess, my basic approach to applying the wave principle to a price chart that I seldom or rarely look at. Okay, so the first thing we need to do whenever we see or look at this price chart of GameStop is put it in a format that is a little bit more, say, discernible. And what I mean by that is we need to go from a linear scale chart to a log scale price chart. By doing that, that actually gives us identifiable waves to work with. So that's a good start. Now this actually brings up another question that I sometimes receive from my subscribers. When you're looking at a price chart for the very first time, how do you actually begin? Where do you begin your wave count? Okay, do you have to go back to the very first day that stock began actually trading? Well, you know, that might be easy to do on some stocks like maybe say Uber, but it might be a little bit more difficult if you're looking at maybe Walmart or even say United States Steel. So what I recommend is simply begin from an extreme high or an extreme low, preferably one that's been in place for maybe say 1 to 3 years. So in this case, what we're going to be doing is we're going to start our wave count from the low that occurred last year in 2020. Now the next step I'm going to do is I'm going to apply some trend lines. Now many of you who might be familiar with my work know about the Kennedy channeling technique, or KCT. It's basically just a very simple trend line technique I developed several years ago to allow me to differentiate between corrective wave structure and motive wave structure. And let me show you exactly what I'm talking about. What we're going to do with this price chart is simply start at that low that we saw last year, and we're going to put on a set of parallel lines. This is what I call a base channel, a KCT base channel. Now the significance of this base channel is that as long as price action stays within this set of parallel lines, then we need to view the market or need to view this advance as a counter trend price move. But when prices begin to move beyond the upper trend line, the upper trend, base channel trend line, well, what that does is it tends to confirm the presence of third wave price action. So this one chart, I think, provides volumes of information about GameStop Corporation moving forward well into next year. But again, the key idea behind KCT, or the Kennedy channeling technique, is that counter trend price action, and as you know as an Elliottician, we use letters to identify counter trend price action. Counter trend price movement or counter trend price action tends to be contained by parallel lines. An impulsive move, a 5-wave move, an impulse wave, is not. So this little diagram that I have right here, let me put that in a small little yellow box for you right there. So the break that we've seen here recently in GameStop, or actually that was back in, what was that, October, November, December of 2020. Well, within this developing impulse wave that I believe that we're currently in GameStop, we're right here. Okay, so now again, the value of the wave principle kind of shows itself. We now have a roadmap moving forward of what we can expect in GameStop. Okay, so next let's begin to look at a little bit of the substructure. So what I've done in this slide here again is just show you I'm going to view this up as wave 1, subsequent price action wave 2. Penetration of the upper boundary line of the base channel confirms the presence of third wave price action. Moreover, if we apply our Fibonacci multiples to the chart, you begin to see multiples which are typically present whenever you're working certainly an extended third wave price move, and that would be those would be the higher multiples. 2.0, 2.618, and even 4.236. Okay, so going back to the little diagram there that I've drawn, Okay, the penetration of the upper boundary line of the base channel that we saw late last year confirms the presence of third wave price action. Moreover, it confirms that we're working a larger impulsive advance in GameStop up from the 2020 low. So where are we within wave 3? That's really the key question, or the question on the table right now. And I think this interpretation fits nicely. I like it for several reasons. So what I'm going to be doing here is simply work wave 1 up, wave 2 down, another one right here. This formation that you see, this blue wave 2 in parenthesis, this structure is specifically identified as a running flat correction. And then we have another 1, 2 here, and then we have wave 3 of 3. I like this interpretation primarily for two reasons. If you're going to see an extended third wave, or wave 3 of 3, or even wave 3 of 3 of 3, which is what we saw in GameStop, this is what it should look like. Okay? Price action is the only thing that can confirm an Elliott wave count. So if you're going to label something as a wave 3 of 3 of 3, well, it really needs to look like this, because if somebody were to ask me, give me an example of what wave 3 of 3 price action is, or what extended third wave price action looks like, I would point to this. Okay? Also, too, let's step back and take a look at this running flat correction. Now, we call it a running flat because wave B of the pattern exceeds the wave A origin point, and then wave C of the pattern, that would be right here, is unable to terminate beyond the wave A extreme. So your wave C ended here. Well, in fact, I'm not in a rush. Let me just go ahead and label this for you. And you'll see that wave C does not terminate below the wave A extreme. Okay, so the end result is what Elliotticians refer to essentially as a truncation, but we don't really call it a truncation because we call it the running flat. But the meaning behind the pattern, the structure, or the inability of wave C to terminate under that wave A extreme is quite similar to that of a truncation or a failed wave. Which, well, let me explain what exactly is a truncation or a failed wave. Well, let's say, for example, you're working a 5-wave move, an impulse wave. Well, wave 5 typically ends beyond the extreme of wave 3. Okay? When it does not, then we call that a truncation or a failed wave. Now, the significance of a truncation, this is a 5-wave move, is that it indicates that there's hidden or underlying, in this instance, selling pressure. So the end result following a truncated wave, waves 1, 2, 3, 4, and 5, would be something like that. Very decisive, very impulsive, because the truncated wave is kind of like the market giving you a very subtle clue or hint that a big move is about to happen in the opposite direction. Well, that's essentially the meaning of wave C of a running flat. So thus, if this is correctly identified as a running flat, then we really should be seeing something quite dynamic to the upside. And I think that's a fairly good description of what we saw in GameStop following the low there back in December of 2020. That's quite the dynamic move, okay? So we have several things that we can actually look at on the chart that support the rules and guidelines, or that do indeed adhere to the rules and guidelines of the Elliott wave principle quite nicely. So we're going back to the 1, 2, 1, 2, and then a smaller 1, 2, 3, 4. Okay, now typically whenever we're working with a fourth wave price move, we're looking for a 382 retracement. Typically the most common Fibonacci retracement for wave 4 of an impulse wave would be a 382 multiple of wave 3. Now, one thing I observed many years ago was that whenever you have a very quick, very sharp, very decisive fourth wave move, its retracement of wave 3 is often very deep, going back to a 618 retracement. In this case here, we actually saw prices move below that level, but notice we got into this small area of congestion. This would actually be a small prior fourth wave extreme. So once again, you see another guideline of the Elliott wave principle adhered to, and that would be the guideline of depth of corrective waves. So following wave 4, we see 5 move up, and here's where the truncation comes in. We have actually a small truncation here, wave 5 of 3. Now, typically, again, whenever you see a truncation, that indicates hidden or underlying selling pressure. Now, in this instance here, because we're looking at a log scale chart, the size of the pullback is a little bit misleading, but we go from, what, $350 a share all the way down to about $116. Well, that's kind of a fairly decisive price move. Okay, so I'm okay with the truncation that you see here. So bottom line, I like the identification up from last year's low that we're working a 5-wave move. We're working an impulse wave. And as of yet, this impulse wave is still very much incomplete. Because if my current count or my operative interpretation or wave count of GameStop is indeed correct, then recent price action or the pullback that we've recently seen is best identified as wave 4 of 3, which means we still need to expect wave 5 of 3. And utilizing just a simple 1.382 reverse Fibonacci multiple of our 4th wave decline, as you can see, that targets roughly, say, 1250 to the upside in GameStop. Okay. Also, too, I like this interpretation because I can clearly and easily identify risk. In other words, where am I wrong? Well, I'm wrong if we fall below 116.90 because that's where I'm identifying the 4th wave move. Okay, well, what next? Do we stop there? Well, no, we don't. And the reason why is because I'm looking at the price chart or the price charts of GameStop from an analytical perspective. In other words, I've got my analyst hat on. And my job as an analyst is to basically look at what could happen in a market. Now, when I have my trader's hat on, I'm looking at what is happening in a market. And there's a big difference between what is happening and what could happen. But I've got my analytical hat on, so I'm looking at GameStop on possibly what could happen. I like this count. It's a solid wave count. It definitely has us pointed higher, and it definitely calls for further rally, certainly back to beyond last year's high of 483, and who knows, maybe all the way up to 1250 moving forward. I'm wrong if we fall below 116.90. But if we fall below 116.90, what would be the next possible best wave count? Well, that's where we take a look at an alternate wave count. Now, I actually have a bit of, say, a love-hate relationship with alternate wave counts. And let me explain. I like the value of an alternate wave count, but sometimes I think the idea of an alternate wave count is sometimes a bit, say, overly used. But in this instance, I think it's valuable because it allows me to drive home a very important point. This would be my, say, number 2 alternate, okay? So if we fall below the 116.90 level, I do not believe that that negates the bullishness that the price charts of GameStop or the Elliott wave count of GameStop actually argues for. It would simply say that, okay, hey, we probably have about another, say, 4 to 6 weeks of decline, corrective decline, back to the 382 retracement of wave 3, which comes into play at 96.60, and then we'll look for, say, maybe a reversal sometime in May. Now, the reason I like May is this allows me to employ another little trick that I work with. I call this the Kennedy timeline. All we do is we simply measure the duration of the prior second wave and move that upward into the wave 3 extreme. So now this kind of gives me a window of opportunity to look for the next proportional 4th wave structure. So that would actually argue for a pullback in this blue wave 4 back into maybe May, and also, too, back to a decline, back to, say, 96.66. At that point, we'll look for wave 5 of 3. And as you saw on the previous slide, once we finish wave 3 here, we still need the appropriate 4th wave decline of this higher degree that goes with this wave 2 prior to still further rally. So for those of you who are still very bullish on GameStop, I certainly can see your point and actually would argue that we could see this advance continue into the fourth quarter of 2021, if not the first quarter of 2022. Okay, and I even have another interpretation just to drive my point home about the value of alternate wave counts. And let's go ahead and put this interpretation up as a viable option. Okay, again, all this interpretation does, it would simply argue that wave 3, the larger degree wave 3 I'm looking at, is complete at 348.5. This would postpone the next rally attempt into June. Okay, now what's the theme? Okay, and this is where I think the value of having an alternate wave count comes into play. What's the longer term narrative? Because remember, technical analysis is a language, and the better you understand the language of technical analysis, the better you'll be able to understand the narrative of the market. Okay, so alternate wave count number 3, down and then higher. Number 2, down and then higher. The operative interpretation that we're working with is basically wave 4 is already done and we're headed higher. So what's the big theme here? The operative wave count, what I think is the best wave count, and the next 2 best wave counts of GameStop still argue that we have more to go. This puppy's not done climbing, okay? So keep that in mind. Now, if the immediately bullish wave count is indeed operative, your critical support, your risk level is all the way down to 116.90. If we fall below that, all that's going to simply do is postpone the next rally attempt, most likely into late May or June, before we see this thing climb again. Thank you very much.